Good morning. This is Jim Hagerty representing Bartlett Wealth Management. Let me start by thanking you on behalf of everyone at the firm. We are very grateful for your support and humbled by your loyalty as we continue to navigate a remarkable period in world history. In our commentary emailed on March 16th, near the worst point of the market sell-off, and a subsequent quarterly update sent on April 3rd, we described how we expected a variety of government policies would be implemented to alleviate the economic fallout of the pandemic. We have not been disappointed. The Federal Reserve Board has undertaken a variety of monetary policy strategies to keep interest rates as low as possible and credit easily available. It took longer, but fiscal policy has kicked into high gear as well, with a variety of measures to help households and businesses. It is believed that the combination of these fiscal and monetary programs is the most aggressive and sweeping federal economic support since the days of Franklin Roosevelt. We thought a combination of government policies and progress on health measures, specifically evidence that infection rates might be peaking, would be keys to a rebound for stock prices. This has happened as we hoped. So following a 34% decline from February 19th to March 23rd, we have had a 30% stock market rebound over the last 3 weeks. This means the stock market is today about 14% below the February high. What is next? Are the skies genuinely clearing? No, blue skies are not in Bartlett's forecast just yet. What would make us more optimistic? Well, we need to see clearer indications that economic expectations have really bottomed out so that the next stage is one of sustained improvement. But at this time, we think conditions are still getting worse for many industries. This is especially true for companies on the front lines of the economy, such as banks and industrial businesses. These companies have been severely impacted. Manufacturers have seen orders delayed or canceled, and banks have experienced increasing losses as businesses and consumer borrowers are under stress. Elsewhere, reports have been better, such as for healthcare companies and businesses that make everyday consumer products. But overall, we think most of the updates coming during April and May are going to be cautious and downbeat. Of course, we also recognize that the impact of the pandemic won't be completely behind us until treatment and vaccine programs are broadly implemented. So we repeat the conclusion from our April 3rd commentary. With most stocks 10 to 20% below February levels, Bartlett is on the lookout for opportunities to buy quality stocks we previously thought overvalued, in the process improving your holdings. But we are not yet making major changes to asset allocation. There will be a time for much bigger adjustments and more risk-taking when we would sell more conservative positions and reinvest in more aggressive investments that have greater sensitivity to improving growth. But for now, Bartlett's more conservative biases of the last year will remain in place. We will continue to favor less economically sensitive companies while emphasizing more balance and greater diversification with less volatile holdings and very careful cash planning. Please know we are just a phone call or email away if you have questions about your investments and financial plans. We're here to help you and honored to do so. Thanks again for your support.